the point of the article is that the IPO market has shut down for oil companies, primarily because the valuations have flipped. The market valuation is less than the value of replacing the assets. In economic terms, this is called Tobins Little Q, after James Tobin and William Brainerd, who developed this metric years ago. When the assets become more expensive to replace than the cost of just buying a company in the market, it becomes cheaper just to go acquire public shares. At this point, there's no benefit to buying the assets privately and then taking them public. Why has this happened? Well, in the frothy Permian and in the frothy shale plays, a lot of money over the last 10 years went flowing into these markets. And at the moment, the rates of return have not been sufficient enough to attract new capital. And until we get to a point where the price of oil is much higher, or there's a supply interruption, which of course would drive the price higher, we're not going to see an open IPO market for oil companies in the U.S. At some point, there will be peak demand. There'll be peak demand for oil, there'll be peak demand, as we've seen, for coal. But over the next 20 to 30 years, as 2.5 to 3 billion people across the planet gain access to energy to get to the 21st century, I don't think we're going to see peak demand coming as quickly as some of the large forecasts have shown, such as BP, Shell, Exxon. I think this may go a little bit longer, and really it relates to the ability to handle the fuel source. It's easier to handle oil than it is to handle coal. It's easier to handle oil than it is to handle generation of electricity and then distribution of electricity and then batteries. And so as long as that continues, we're going to see increasing demand for oil across the world. Well, shale oil is the high-cost barrel to bring on. What the private equity funds, what the MBAs and the CFAs like about shale plays is that it reduces the risk of hydrocarbons in place. In other words, it's not an exploration play. It's really just reservoir quality and hydrocarbons recoverable in place. And so what we've seen is they tend to view the shale plays and the horizontal plays as simply oil in place or inventory in place. Just-in-time storage would be the way a manufacturing company or Walmart might look at it. They can go drill a well and produce oil right away. There are a couple of different shorter timelines, if you will, for shale oil. One is it's relatively quick to find once you know it's in place. And so drilling a well, fracking the well, bringing it on production is relatively simple. Multiple wells from a single pad certainly reduce the opportunity for any delays in getting to market. The shale wells also deplete faster. And so to a certain extent it can be ramped up very quickly, but that type of activity has to continue to multiply because the faster decline rates of these wells versus conventional wells, which would say be 3 to 5% a year, mean that continued drilling activity is required to keep levels of shale production up. I think if we see an extended period of price above $80, we'll be able to see the IPO market come back. The shale plays in particular are high-cost plays. And back in 2012, the low average marginal cost was $50 a barrel. Certainly it's diminished over the last 2 years since the 2014 attack by the Saudis to run some of the shale play companies out. And for perspective, this has cost the United States more than $250 billion in direct capital, more than 250,000 jobs, more than 300 bankruptcies. And Wall Street is gun shy and not excited about putting more money into a play where one really has to depend upon the actions of OPEC to maintain the price and to maintain rates of return.